Hey guys, welcome back to another video. Today I'm trying something interesting. I guess for the past few videos the theme has been about money, and I just wanted to understand more about money and what role it kind of plays in the future. So we have Grok on the left side to explain the origins of money, its evolution from barter to digital currencies, and how it facilitates trade and economic growth. And on the right, we have ChatGPT kind of examining money's influence on power, inequality, and its changing nature in an era of cryptocurrencies and central bank digital currencies. So let's get right onto it, starting with Grok first. The origins of money. The origins of money are rooted in human attempts to solve the inefficiencies of trade and exchange. Contrary to popular myth that money evolved directly from barter, evidence suggests that early societies relied on more complex systems of credit and mutual obligations before formal money emerged. Pre-money systems. Anthropologists, including David Graeber, argued that barter was rare as a primary system. Instead, early human communities used informal credit arrangements based on trust. For example, if one person gave another a tool or food, the recipient might owe a favor or goods in return, tracked socially rather than with a medium of exchange. These systems worked in small, tight knit groups where reciprocity was enforceable. The emergence of money. Around 3000 BC, in ancient Mesopotamia, the first forms of money appeared as societies grew larger and more impersonal. Temples and rulers began standardizing units of account, like barley, or silver, to record debts and taxes. These weren't coins yet, but ledger systems. Physical money, such as silver ingots or weighted metal, followed as a portable way to settle debts or pay tribute. The role of the state. States and empires accelerated money's development. In the 7th century BCE, the Lydians in modern day Turkey minted the first coins, stamped metal guaranteeing value. This was less about trade convenience and more about power. Coins paid soldiers and taxes, tying people to centralized authority. Money became a tool to quantify obligations and enforce economic control. Evolution from barter to digital currencies. Money's evolution reflects technological, social, and political shifts. Barter. Mythical starting point. The traditional story posits that barter, direct swapping of goods like fish for weight, or was humanity's baseline. However, barter requires a double coincidence of wants. Both parties must want what the other offers, making it impractical for scaling trade. Historical evidence shows barter was more common in societies where money systems broke down, not as a precursor. Commodity money. Early physical money was tied to valuable goods, grain, shell, like cowries in Africa, or metals, silver, gold. These had intrinsic value and were widely accepted. By 1000 BCE, China used bronze tools and later standardized spade and knife money, while precious metals dominated in the West. Coinage. The shift to coin money around 600 BCE standardized value and portability. Coins backed by rulers reduced dispute over weight or purity, facilitating trade across regions. The Roman denarius and Chinese cash coins are classic examples. Paper money. Originating in China during the Tang Dynasty, 7th century CE, and formalized in Song Dynasty, 11th century. Paper money began as a promissory notes for merchants avoiding heavy coins. Europe adopted it later, with 17th century goldsmith receipts evolving into banknotes. Paper money was a promise of value, often tied to the gold or silver reserves. Fiat money. By 20th century, money detached from physical commodities. The US abandoned the gold standard in 1971, making the dollar fiat. Valuable because governments and societies agree it is. This shift allowed greater flexibility in money supply but introduced risks like inflation. Digital currencies. Today, money is increasingly intangible. Credit cards, 1950s, online banking, and mobile payments, example, PayPal and Venmo, digitize fiat money. Cryptocurrencies like Bitcoin, 2009, take this further, using blockchain to create decentralized, trustless systems not controlled by states. Central bank digital currencies, CBDCs, like China digital yuan, blend state backed fiat with digital efficiency. How money facilitates trade and economic growth. Money solves practical and systemic problems, driving trade and economic expansions. Medium of exchange. Money eliminates barter's inefficiency. You can sell goods for money and buy what you need later, enabling specialization. Farmers don't need to find bakers who want wheat, they just need cash. Unit of account. Money provides a common measure of value. Prices in dollars, euros, or yen let people compare goods and track wealth, simplifying complex economies. Store of value. Money holds purchasing power over time, barring inflation, allowing savings and investments. This fuels long term projects like infrastructure or businesses, unlike perishable barter goods. Lubricant for trade. By standardizing value and trust, money enables trade across distances and cultures. Roman coins circulated from Britain to Egypt. Today, digital dollars move globally in seconds. Economic growth. Money supports credit and investment. Banks lend money for startups or homes, multiplying economic activity beyond physical cash. Fiat and digital systems amplify this by expanding money supply as needed. True mismanagement can lead to bubbles or crashes. Innovation and flexibility. Digital currencies reduce transaction costs and borders. Bitcoin enables peer to peer transfers without banks, while CBDCs could streamline welfare or tax systems. This adaptability spurs new markets and efficiencies. In summary, money didn't evolve linearly from barter but emerged from social needs for trust, record keeping, and control. From Mesopotamian ledger to Bitcoin, it's morphed through commodities, coins, paper, and code, each stage enhancing trade's scale and speed. By abstracting value, money unlocks specialization, investment, and growth. Through its power also concentrates in the hands of those who control it, from ancient kings to modern central banks. Today's digital shift promises even greater fluidity, but also new challenges in trust and equity. Now we move on to ChatGPT. Money's influence on power and inequality and its changing nature in the era of cryptocurrencies and CBDCs. Money has always been more than a medium of exchange. It is a tool of power, a driver of inequality, and constantly evolving institution. As we transition into an era of cryptocurrencies and central bank digital currencies, money's influence is shifting in ways that could either reinforce existing power structures or challenge them. Money as a tool of power. Historical context. Governments and financial institutions have historically controlled money through centralized banking systems, taxation, and debt creation. The ability to issue currency and regulate its supply has allowed states to exert control over economies and populations. Central banks, particularly since the creation of the Federal Reserve in 1913, have played a pivotal role in shaping global economic policies. Modern implications: CBDCs and state control. With governments introducing digital currencies, central banks will have more direct control over money supply, interest rates, and even individuals' transactions. Financial surveillance. Unlike cash, digital money leaves a permanent record, giving governments and institutions unprecedented power to monitor economic activity. Sanctions and financial warfare. The ability to freeze assets, exclude countries from financial systems, example SWIFT bans, or manipulate exchange rates underscores money's role as a geopolitical weapon. Money and inequality. Wealth concentration. Financial systems have historically favored the wealthy with policies such as quantitative easing (QE), inflating asset prices, stocks, real estate, benefiting those who already own assets while leaving the working class behind. Debt has been used to create dependencies, with poorer nations and individuals forced into cycles of repayment that keep them disadvantaged. Cryptocurrencies and economic inequality. Potential for financial inclusion. Cryptocurrencies promise decentralized access to financial services for the unbanked population, bypassing traditional banking barriers. Speculative wealth and risk. However, crypto markets are highly volatile, often rewarding early adopters and leaving latecomers at risk, reinforcing inequality rather than solving it. Institutional adoption. Large corporations and banks are now entering the crypto space, which could shift power back to traditional finance players rather than democratizing wealth. CBDCs and the risk of a two-tiered system. Government issued digital currencies. While CBDCs could improve financial efficiencies, they also risk reinforcing government control over individual finances. Negative interest rates and financial penalties. Governments could implement policies like negative interest rates or expiry dates on money to force spending, disproportionately affecting lower income individuals. The changing nature of money in the digital age. Decentralization versus centralization. Bitcoin and decentralized finance (DeFi). These technologies challenge the traditional banking system by removing intermediaries enabling peer-to-peer transactions. CBDCs and greater control. While CBDCs offer efficiency and security, they also reinforce centralization, giving governments greater power to track and control economic behavior. Shift from physical to digital money. Loss of cash-based privacy. As societies move away from physical cash, financial privacy decreases, making individuals more vulnerable to government and corporate oversight. Programmable money. CBDCs could enable programmable money. CBDCs could enable programmable spending, where governments set conditions on how and when money can be used. Example: welfare payments can only be spent on specific goods. Global economic implications. De-dollarization. Cryptocurrencies and CBDCs could challenge the dominance of the US dollar as the world's reserve currency. Financial inclusion versus surveillance. While digital money could bring financial services to billions, it also raises concern about authoritarian control and loss of individual autonomy. Conclusion: the future of money and society. The transition to digital money presents both opportunities and challenges. While decentralized cryptocurrencies offer the potential for greater financial freedom, they also face the risk of regulation, volatility, and institutional capture. On the other hand, CBDCs provide efficiency but could strengthen government control over personal finance, raising concern about financial privacy and individual autonomy. As a civil engineer and someone interested in AI's driven debates, you might explore these questions. Who should control the future of money? Governments, banks, or decentralized networks? How can financial technology balance economic freedom with security? What are the implications of digital currencies on global power dynamics and infrastructure funding? So, both Grok and ChatGPT had once again good insights on the topic and the two topics, and I think I'm going to further explore the ChatGPT suggestions. That is a quite cool feature that they have included that there. Yeah, so that's the video for today. I was just curious on how both AIs would respond to the two different questions that have been asked, and they both gave quite a detailed explanation of the two topics. And yeah, I will see you guys again with another video pretty soon. Cheers.